Welcome to the new Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. And we're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Millikan's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Welcome to episode 16 of the new Barbarians podcast. Today's Monday, April 14th, 2025. The podcast will hit platforms later today. The big news last week was tariffs yet again. Trump reversed policy a little bit and reduced tariffs across the board to 10%, but raised them for China on Wednesday to 145%. China retaliated and raised them.
Did you say a little bit? Trump changed policy a little bit, Bill? It's like a ping pong game with cinder blocks. I mean, going across the table.
It's a relative thing, Mark. And, you know, when you're announcing huge policy shifts that have massive implications for the economy on Truth Social, I suppose these things are all
everything's
relative.
tongue-in-cheek, yeah.
So anyway, there's a 90-day pause for most of the trading partners who are willing to negotiate, and then clearly Trump is punishing China. There was a splintering of Trump's cabinet with Elon making derogatory remarks about Navarro, and Bessent is now sort of center stage with the economy. And Mark, you may as well discuss James Carville's famous quote about the bond market in 1994.
Yeah, just to paraphrase it, I don't know if it was in reaction to the Brady bond crisis, or I forgot there's another derogatory term for it, the burrito crisis or something, when, the peso devaluation and in Mexico, and the bond market came in quickly as the arbiter of value and punished those bondholders. Carville said, I used to think that if I was going to come back in life, I'd like to come back as a baseball player, Ted Williams, or an astronaut. He said, but now, after seeing this, I'd rather come back as the bond market, because no one messes with the bond market. I think was the upshot of that quote, and slightly butchered.
I was still a little busy graduating from high school then. I wasn't paying attention to James Carville and the bond market. Pre-market, Nikkei's up over 1%. Hang Seng, which surprised me a little bit, is up 2.4% given last week's news. I would have expected China to be down, but as you explained,
Bill, I think we when 2 weeks ago or maybe it was a month ago, we observed the DAX rising and European equities getting a bid. Actually, it was even earlier. It was kind of like in Feb. And we're like, why the face, man? It's Europe. They have no growth. But as you said, the outlooks didn't catch it from Wall Street at all. But the market is so wonderful. It said, why do I want to own a 25 PE stock? Let me own a 12, 14 PE stock. So it's just being defensive. And the worst performing equity market in the last 3-4 years has been China. So they're like, let me just hide out here. And they know China, which we'll touch on later, is going to stimulate. So assets are going to entities that are going to stimulate, like Germany did with, they're taking away the debt brake, which again we'll touch on. But I think that's why it's just like the less dirtiest shirt, because you can't say bells are ringing. Tell Trump we'll talk to him later. And to get back on X off of True Social, for God's sake.
So stimulus offsetting shutting down the largest global trading partner, and clearly the trade war is still on. But
it's reaction.
Yeah.
It is not looking, beyond a day, a week right now. There are growth implications, certainly. And again, we have a chart to show that with China. But people are like, let me just hide out, because I think in the next week, the Hang Seng has already gotten, its head handed to itself. It's already beat up. Let me throw some funds in there.
So Europe is up across the board about 2%, 2+%, and then in the U.S. Nasdaq is up almost 2%, and the S&P should open at up 1.6%. So it looks like the pre-market in the U.S. is good, but we've also seen that reverse depending on what kind of truths that Trump may truth later on today. And with that, I will let Mark take it away and give us the scorecard for the macro setup following all of this crazy news.
Yeah. Here I go. It is happening fast and furious. So just to share our model as I go through markets. In 2008, I keep, if I've said this before, fast forward this part. I was a head of risk at a multi-billion-dollar hedge fund. Things were happening fast, and the central banks and treasuries were making up new rules, new entities of support every weekend, floating a trial balloon, seeing if it would take hold, and if it did, they would say, "Great, go with it," and a bunch failed, but that's what they did. So the news was coming so fast, I had to put everything in 3 buckets, 1 of 3. Was the news an economic dynamic? Did it impact? Was it about inflation? Was it about money supply? Was it going to impact GDP? Was it a market dynamic? And then what player was doing it? So those are the 3 buckets, and I look at the reaction function across all of them. So just to kick off today, as we look at the scorecard, which shows I think still an acceleration in gold's price. Year to date, it's up 23. Is that right? It's up 23% year to date. And so just the first 11 days of April, it's up 36%. Throw a, for math, times 3 on that month. So annualize the month, or it's accelerating. So let's look at what's going on. GDP, we're going to have a negative print. Consensus is for positive. The Atlanta Fed we showed is down 2.6%, 2.3%. We're going to have a negative print, not priced in. That's a yellow flashing red, GDP. Inflation, yellow flashing red. JP Morgan came out and said, you got to look at a PCE that's now going to be 4 to 4.5%. That's not where PCE is right now. That's yellow flashing red. Problem. Interest rates, yellow flashing red. Bessett wants them lower, they're higher. That's a problem. Deficits are accelerating down, yellow flashing red. So the economy is not in great shape, except for one thing, employment, which always lags. And the reason that's a big deal, because it's a political hot button. And with midterms, still 2 years away, they're not worried about it. So I think employment is going to go yellow to red over the next couple of months. Let's look at markets. Equities.
Sorry, Mark. One question: is oil down almost 14% in the last, half of April? Just in the first half of April?
Yeah,
that's pretty big.
Yeah. No. All these. As soon as that Wednesday night massacre, it's going to go up with the Sunday night massacre in 71, August 15th, with the dollar. Literally, he broke Bretton Woods, Nixon. So the Liberation Day will go on par with Nixon's. I've instructed Treasury Secretary, escapes me at the moment, to suspend temporarily the conversion of dollar into gold. Trump's Liberation Day with the charts is a parallel statement with tremendous long-term impact that are still not priced in. And we'll point to the first rung of the ladder ascending us into a new regime of deglobalization is when Germany took away its debt brake, installed after the global financial crisis, to ensure that it remains fiscally austere. They removed that. It's a constitutional amendment forced by Trump to say enough. You can call it right or wrong about NATO funding, but when you look at oil going down 14% a month, Bill, he said, I'm surprised. What happened surprised a lot of people when they realized what a tariff game means. It means that the trust that was from a global economy where there was an engagement or a distribution of resources and, a shared gain in an ascension of economic growth, that's gone, broken. We may be able to repair some of it, but it'll never return to where we were prior to April 2nd.
And that's just bad news for the economy.
Bad news for the economy. And as Jeff Rosenberg from BlackRock said over the weekend, it'll create winners and losers. So, the folks on your side of the fence, the quant researchers, they'll be alphas because this is a different game. It's going to be a commodity-based economy, and we see that with commodities outperforming equities. It's going to be a deglobalization. So the game changed, and there will be different winners and losers going forward than we had, say, in the prior 5-10 years. So I went over the economy with employment being the last leg, the last shoe to drop, and I think one that the policymakers are willing to endure, again, given that midterms are still, 2 years away. And
before the call, we actually spoke about employment being lagged by like 6 months. So the good employment numbers are misleading.
Yes. And my turn for Donald Trump to call me. And the reason we belabor the economic point, and we said 3 to 6 months, Bill, but remember during COVID, when you have a huge shock like we did, employment went quicker than 3 to 6 months. I think it was like 2 to 3 months. So depending on the shock, and this is like a COVID shock, supply side, people didn't walk away from the economy. There were barriers put up to the economy actually being able to happen. In 2020, it was stay home or go to jail, effectively. And this one is, if your goods come over, the receiver is going to pay 10 to 145% in extra penalties. So the economy is seizing. It's going to seize. And the markets, again, it's all about fixed income, flashing red. And we're going to show a chart in a minute about where that is. And on the player front, industries, Delta, others pulling guidance, yellow to red. Productive industry, corporations are seeing the problem and they're getting low to ground. They're not giving guidance. The consumer, you mentioned, yellow to red, poor. Asset managers, yellow to red. Hedge funds, smartest folks in the room, not doing well. Passive flows are going to low cost or low risk assets. All out of the AGG, the Barclays Bond Index, negative flows, month to date, week to date, on the day. Where are the flows going? Into T-bills. The BIL ETF is up on the month, on the week, on the day. Its flows are up 50% on the year. It had 30 billion. It has over 45 billion in flows. It's one of the largest, bond funds out there now, or ETFs rather, next to the AGG and the BND. And no one cared about the bill fund, Bill, because it was a low rate. Now everyone loves 4.5%.
So, yeah, what's happening to the yield curve then?
Yeah, so the yield curve has surprisingly, even though not surprisingly, the yield curve is steepened. And let me rip through that. Hold that thought, because we're going to show you the damage and the voting, back to the Carville quote about the bond market vigilantes. So this is April 2nd. We talked about Liberation Day being akin to the Sunday Night Massacre. Well, look at the dispersion that you're seeing among assets after that, from the 3rd on. And you talked about oil, Bill. Well, look at oil, that black line, which was flat month to date, and then it just, took a hitter, in 2 days.
Yeah.
So the market says, hey, maybe we're lifting here, starting on that reversal, saying let's put a stay on most of them for 90 days. This game is not over at all. The reaction function is still rippling through economics markets and the players, including corporations and consumers. But so I'd be remiss. Go ahead.
We do have a whipsaw now, right? So we have Tuesday, Wednesday, Thursday down, Friday up. Looks like today will probably be good or okay, at least in equities. And is the market digesting this? I know, we make baseball analogies, but where are we in the normalization of this information?
Yeah, I said 6th inning beforehand, but I think we may be a little earlier. I did a Substack when I wrote about how long it takes governments to figure things out. Lehman filed bankruptcy. I was at a hedge fund. People thought, hey, listen, Dick Fold, smart guy, he's got 8 bids for the company, no problem. Lehman's bankruptcy surprised the entire market. People close to it. Why? Because you can't fool around with leverage and asset liability mismanagement. They were front loaded, and then JP Morgan, well known, said no more funding. They pulled it, then everyone pulled it, and they filed bankruptcy. It took over 3 weeks for the government to get that first round of funding in, and it took another 2 to 3 weeks to get the next wave, where corporations had to have their short-term money 3 years in ring fenced with something I think called TLGP, where they gave 3-year and in money government agency protection. So these things kept happening for weeks and almost 2 months after. Companies haven't had time to react to this. And look at this graph again. April 2nd. Hey, listen, no problem. We even have NASDAQ rising on the month going into that Rose Garden announcement. So we are still early. We were 9 days, we're 9 days in as of before today's open. 9 calendar days in, not even trading days.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.
So we are still digesting what happened in that Rose Garden on that moment. So, and again,
but one line does not look quite like the others, and that is Bitcoin, correct?
Bitcoin and gold had, I'm a Bitcoin advocate for a number of reasons. Even before this debacle where trust is out the window and dislocation is going to, I think, be the pattern going forward in supply chains and economic patterns. But gold really is the true signal. Gold, the demand for gold disrupted the Bank of England, where you had that very sort of bizarre statement by one of the directors, not the head of the Bank of England, but one of the directors in late Feb or early March, where he said, yes, we're having some demand for gold. I couldn't even get through the door today because there was a lorry in the front courtyard moving the gold. Gold's heavy, he said. It takes time to move. Like these bizarre statements that are not news, that gold is heavy, were used as reasons why there's a 8-week backlog on delivering gold. In fact, the amount of gold exported is the main driver why the Atlanta Fed now GDP estimate hit a negative 3.8% number. So is that a big deal? Yes. It's not just retail buying it. And yes, the gold ETFs have had inflows just like the T-bills. It's institutional. It's central bank demand. And it's not new. We wrote something in July about treasuries being an asset turned into a liability because, or supported by the fact that gold is now the haven of support. So yeah, Bill, you're right. Bitcoin certainly, and I still have a 250 target on Bitcoin for the end of the year, and I have not given up the best case of 450 by any stretch. Why? Because of, look at this chart. We're still digesting a change in the global monetary trade game installed really post World War II. And Ray Dalio has also spoken about this. He said recession's there, but the bigger point, which people don't have the time or the incentive to look at, is if we change the monetary regime, dollar-centric, put all the gold at the Fed, we'll issue dollar bills, as happened after World War II, and we'll have a faster money. Never had that before. Never in the history of the planet did other countries push their gold into another country like they did during World War II as a function of Bretton Woods after that 1944 meeting, I believe. All the countries put their gold in the, bottom of the Fed, and then we issued dollars against it to rebuild the world. And that stood until Nixon broke it. But the dollars, then instead of being gold being the reserve asset, we said have our treasuries be the reserve asset. Well, let me go right to the chart, Bill, that says that game's over.
That's there we go.
This is a chart. I forget the rest. As Tom Keene would say, let's rip the script up. This is the chart everyone should look at. The first time we're seeing a separation between interest rates via the 10-year and the dollar. If you look at the relationship, you see a correlation. As rates go higher, it attracts flows in terms of dollar demand, DXY, which is a basket of basically G4 plus currencies, euro, pound, loonie, which is a Canadian, the yen, others, Swissy, etc. The dollar is down. It's the lowest in over 4 years, 3.5 years. And look at the rate. People are selling bonds in a time of stress.
And so I think it's important to maybe just walk through the chart a little bit. So we're looking at the 10-year versus the dollar, the 10-year yield versus the dollar over time. And, there's a very clear relationship, and I'll do some statistical studies on this and see how significant this is, but it's clearly crazy significant. And this is the first time you see them really deviating. I don't know how far we can go back, but certainly over the last couple of years. And I think that this is also a proxy for the yield curve and, economic expectations. Typically, the 10-year goes up, you have good expectations about the economy. When especially the Fed is raising interest rates and, the short end is driving the long end. But in this case, that is definitely not true. The only reason why the 10-year is going up significantly is because people are selling bonds. And then you simultaneously see the dollar dropping off. So this is just, clear as day, a bad indicator for the outlook in the U.S. economy.
Yes. And Bill, worse, the U.S. financial system.
Right.
We're able to have so much debt because our treasuries are deemed to be assets, pristine stores of value like gold. Well, as you said, I don't know how far it's gone back. We just went back to talk about another period of dislocation, which was our rate rise. As rates rose, the dollar got bid because everyone said, hey, there are other problems I don't like low growth Europe or LATAM or, China's a closed economy. I'm going to put money into the U.S. because I love that 3, 4, and climbing 4.5% yield. So we attracted flows. Clearly, you see that between that 21 into 23 period, and that pattern of relationship you see sort of maintained until recently. So, yeah, the statistical analysis will bear out that this is a brief but clear departure that I think indicates a regime shift like Ray Dalio. They always take longer, but I think it's alia jacta est when it comes to the U.S. being the trusted Treasury reserve asset.
Now, on the flip side, if I was to express some optimism, when this chart returns to normal, do we then think that, the market has kind of digested this and the outlook is at least reliable? Like this just looks like chaos to me. So I think even if expectations are kind of bad, if this chart kind of normalizes, can we say that, yeah, we're at least in the later innings of this
Yes.
forecasted recession, which I think, plays out over a quarter, and then, maybe we lower rates and pump the economy with stimulus and buying bonds and whatever else.
There you go, Bill. You said it. And buying bonds. Back to the players where it's green. Central banks and Treasury haven't acted. So who's going to buy our bonds? I don't think the Bundesbank has to sell their own in order to fund.
Right.
So they're not going to be like, oh, let me help out the U.S. and buy their bonds. They've got their own higher yielding now bonds to sell, and I'm sure the Germans will be happy to buy them over U.S. Treasuries. So what's going to happen? We're going to do that, maybe a regulatory change and allow banks to buy Treasuries with zero collateral down like they did during COVID. That 3 letters you're going to want to listen to are SLR, the supplementary leverage ratio, which will be suspended like Germany's debt brake. So again, austerity put in, prudence will be thrown to the wind in order to maintain what Carville aptly said is the most powerful force in the planet, the bond market. So yeah, that'll happen, but I think it'll be with either the Treasury, the Fed buying bonds, or regulatory change allowing banks to buy bonds with no collateral down.
Cool. Well, I'm looking forward to seeing this chart every week now.
Now, before we go over some of the stuff that you want to look at, I want to go higher level about why is this happening. This is happening because our debt load is at World War II levels, but we have a very different demographic, as opposed to average age of that demographic being in the 30 to 50-year-old range. We have a big 60 to 80-year cohort that's going into retirement, that's going to draw on Medicare and Medicaid that didn't exist back then. So our deficit spending is at risk of increasing. So when we look at the share of global GDP, with G10 here being almost 50%, and the BRICS being 27%, which this ratio used to be 66%, G10. So this little group is gnawing into the pie of global GDP, with 2 entities really driving it. You have the G10 countries, which again account for 48% of global GDP, the 104 trillion. U.S. is 27.7. This is 2023 data. So this is 27.7 trillion. China is 17.8 trillion. Together, they're about 43, 44%. 2 countries, almost half of GDP. So is the game really between those two? Yes. this is new. China's GDP before they were allowed into the World Trade Organization was less than 2 trillion. So the rise of this juggernaut is faster than any country on record. And now they're asserting themselves from a military standpoint when it comes to chips. So I'll back off on the political statement, but look at the dynamics. 104 trillion across 192 countries, but only 2 account for almost half of it. That's why you're seeing this standoff. And because the U.S. is between a rock and a hard place, with 25% of our interest expense accounting for, or our receipts are eaten up by interest expense, by over 25% of it going to pay interest expense alone. And that's going to rise. That's why Bessent wants rates down. He can't get rates down. That's why that chart that you liked is uber important. His game is fouled. His job is to get rates lower because he's issuing 11 trillion in debt. Unless he gets it below 3%, our interest expense will rise because we're coming off a very low coupon roll out of the post-GFC crisis. So that's the game. Any good news, Bill? Oh, sorry. I think I gave your label as Mark Connors. Here, I just want. I'm going to put down Bill Mann below it there for the audience.
I think that I think we need to see how some of this plays out, but I suspect that the U.S. Standoff with China is a lot worse for China than it is for the U.S. Like, we lose our exports to China, which are not a big deal, but it's a really big deal for them to lose exports to the U.S. So depending on where the negotiations go, or if this stays in place for some period of time, it can't, just stay this way, or China blows up, right? What is the end game for China to, keep retaliating?
Okay. I'm going to bring up I just had it here. This is not a plug. It literally, is it reversed, or can you see it?
No, I can see it. The big print. What
so
happened?
Larry Lepard is a investor and Bitcoiner. I've done a couple panels with him. He just wrote this. I think it's going to be one of the most timely books ever written. He's not the first to talk about it, Bill, but you're right. China is in a worse spot, and they've already started to lower rates. They've started to push their yuan, devalue it. Again, currency manipulation, certainly. It's a command and control economy. They're going to print money. They have to. They cannot afford, and we didn't share our slide, but their housing prices, their residential property prices, started to decline right after COVID. And it's down, 15% or so. An economy that's that levered, to have prices go down 15% is a big problem. So they're going to print. Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
Also, now that you bring that up, I'm reminded there was a article about China selling U.S. bonds and treasuries in order to devalue their currency. Could that be driving some of that rise in the 10-year from that chart that looks so crazy? Yes.
But China, we looked at the big number, big GDP. We have big debt. So we are actually a deficit spender, which is odd, right? Let's just look at the position we're in. 4% unemployment, great. 2 to 3% GDP the last couple of years, excellent. Then why are we spending 6 to 7% of our GDP overspending in deficit? It's because without it, we wouldn't have employment at that level, and we wouldn't have GDP. So back to your question, which your question was about China.
Yeah, I guess you were asking me about bright spots, and I think the only bright spot is really that this standoff has to end.
Oh, right.
And when it does, that's probably good. I don't know how it plays out, but
I know where I was going
know.
with Bill. I think a recession's gonna happen. We're gonna chew a recession because I think that's the only way that Besson gets his rates lower. We go into recession, demand drops, and the Fed is then allowed to save the day by not just cutting rates, because the price of money doesn't matter when we need to keep issuing debt. The supply of money needs to be absorbed. There are only two places it can go: into our banking system as a free carry trade with no collateral.
So, and maybe you can help me explain this. The CPI, did it fall in March? I think I'm reading the headline right, that it's the lowest monthly rating since the COVID-19 pandemic. That's good for the Fed then, right? They aren't going to be as concerned about inflation.
That definitely helps them. And things are so fluid now that there's a chance that it continues to drop. Obviously, autos were a part of that decline. There were some services that declined. It wasn't just the core. It wasn't just headline, which is obviously oil, which wasn't in that number because oil dropped 14% in April. It didn't drop 14% in March. So headline will continue, and that's a big deal. Oil is a feeder stock for a lot, so that I'm not discounting that. The play that I'm doing, again, if markets discount, future prices, equities were lower, oil's lower, that's stagflation. Bitcoin and gold are up because of that book I raised just a minute ago, big print. Because the only shoes to drop in my chart when I shared verbally are central banks and treasury. Industry's already said, I don't know what's going on.
Right.
Reducing guidance, and we've already seen some, employment cuts. The consumer's getting low to ground. You've pointed that out.
Yeah, I think it would be interesting to see how many companies are actually removing guidance. It's like a pretty good metric, and I'll get that for next week. And then another headline is the University of Michigan Consumer Sentiment February survey showed consumer confidence falling to a 29-month low. So is Besant, are Trump and Besant getting what they want? This is real indicators that the economy is slowing. Inflation is no longer a concern. Is the Fed getting what they need now? Or is Powell still going to be defiant like he was 2 weeks ago?
They had to be forced.
Yeah.
Look at the MOVE index. And this is why I think we're not done yet. And we still have and back to Carville's quote, we still have a market focused on equities.
And so now I do get to bring up Trump's quote, worrying that people were getting a little queasy. I wish I could do a Trump imitation. But I imagine when he said people were getting a little queasy, he was suggesting that the Fed do something. And he obviously asks for this all the time. So
yeah, he wants cost of money lower. But JP Morgan, and again, they're not the oracle, but I agree with their rationale. that if you force companies to accept goods at the border, and again, we don't have a 3%. Trade is not 3% of our economy; it's 25%. We talked about that. Net exports imports is only $1 trillion. $1 trillion of 27 is about 3%. That's not the number. 14% of our economy is imports. 11% are exports. All of those goods are going to have a tariff on them. Not just the net number, all of them.
Right.
And they're going to be paid by the person taking them in China, in Vietnam, or in the US. And that company is going to either eat it, and their margins are lower, look at the stock prices, or the consumers are going to pay it. Look at consumer confidence. So the fact that people think inflation is going to be lower is bananas. Prices are going to go higher. The economy may slow, but that's where that nasty word stagflation comes in. And that's why JP Morgan went to a 4.4% PCE. That number just shot Powell right between the eyes. 4.4, can't cut rates into that. That's why there has to be a forced action if the financial system breaks. We're going to do SLR, let banks buy bonds for free. The Fed may say, I'm going to do QE, but I won't raise rates. So that makes sense to me, because that gets that reduces the pressure on treasuries. Hopefully Besson gets his lower rates, but it doesn't make the cost of money lower necessarily in the front end. It just tames the beast in the back.
Okay, well, we are starting to run out of time, so I'm just going to quickly rattle off a few notes about quant factors and the stock market. So Asia ex-Japan flocked to safety. So large caps had a 5 sigma move to the plus side, return on equity. So quality stocks did well. So it's not a sell-off as much as a rotation again into safer names. Growth had negative, almost 3 sigma. So people, rotated out of risk and into safer stocks. Same thing happened in the US. Value had a sell-off. I'm not sure where that is in the sigma space, but book to market was down 3%. Dividend yielding stocks were down. And interestingly, sales growth in the U.S. was up. So maybe that's also just a bounce back in the NASDAQ and some people liking getting back into, Mag 7 and things like that. And then sensitivity to oil price rallied. And, I think that's all just because we saw. Did you say there was a bounce back in oil end of last week? Or
a little bit. Yep.
Yeah. So I think that would explain. Yeah. So that's obviously just, Thursday and Friday last week.
Yeah.
But I guess the whole point of this is, and interestingly, I can actually even go back to March. Like, I think that when I look at the performance of quant factors, despite the fact that they are statistically significant, meaning that, moves that we're observing are just way bigger than history, especially recent history. But these rotations into, safer names, and this again gets us back to Europe and what I think we saw earlier in Q1 is pretty much understandable behavior. Like, I don't think we can always predict these things, but looking back, it seems like investors are behaving sort of as you would expect. Yeah. As uncertainty goes up and things get a little wacky, people are getting lower to ground, but they're not selling everything. They're actually just rotating into safer names. And this does get back to stretched PE ratios. So you go into safer stocks with lower price to earnings, and again, getting back to the silver lining, if PEs now are going to look a little more attractive in the US, maybe we'll have a safer investing regime in the US stock market. And then, of course, everyone should probably consider Bitcoin being a uncorrelated asset that should go up with fiscal stimulus and monetary stimulus on the way, because it looks increasingly like that will happen.
Yeah, there's no doubt that a print will have to happen.
And when does the NBER actually make their assessment? It's on a lag too. So like, I think Trump and Bessent, whomever needs to motivate the Fed will have what they want as soon as that declaration is made, correct?
It's Q3. I mean, you have to have 2 quarters, and it's always in arrears. So the markets will move a lot faster and tell you what's going on, for sure.
And yeah, I guess the Fed just needs to face the music first, and NBER will come out and tell us what happened after the fact.
Look, yes, they'll be the reporter, but the Fed has to be forced into that move, and this is going to be. I mean, Powell has not played ball, and he's certainly not, a Trump disciple by any stretch, nor should he be. And the China gambit, who's weak, can they make them, buckle? And I don't know what buckling even means, Bill. Like, what do they want from China? You're going to trust what they say? So that's why people are thinking that this is a different monetary regime. Equities will reset, but you still have earnings ready to come in. They've only been reduced by 7 to 10%. So, that's a story for another podcast. So definitely, folks, please hit like and subscribe. We want to reach more people, and we'd love to hear from you as well in the chats on what you want to hear.
Yes, please do engage with us on social media. Especially, we would be very happy to answer questions that you have, especially follow-ups to some of the things we spoke about today. Thanks a lot.
All right, take care, everybody.